Hello, everyone. Welcome to another week of Taxes in Retirement Live. I am Andy Panko, owner of Tenant Financial and host, moderator of Taxes in Retirement Facebook group. Thank you. Today's topic, got a good one. Today, I will be discussing what is a financial plan. So that term gets thrown around a lot, sometimes in this group, sometimes in other groups. Sometimes you've probably come across it in your travels elsewhere. People talking about a financial plan. What is it? Do you want one? Do you need one? I will go over a real live, well, not live, it's sample, it's dummy info, but I will go over the process of a financial plan, show you what it is. They're all going to look in, depending where you go, what software the person uses, what their approach is. The financial plan or planning process you may go through may look and feel a little different, but fundamentally they're all kind of the same thing. So I will get into that. First, thank you. I'm not entirely sure who it's from, but I did receive this in the mail. I have gone 0 days without making a dad joke. My previous record was 0 days. I am not really sure who it's from. I think I know it's someone in the group, but I have not yet confirmed with him or her. So whoever this was, if you're watching, thank you very much. And just let me know that it was indeed you or not. I appreciate the shirt. Thank you. Dad jokes. Before I get to the disclaimer and the financial plan. All right. Dad jokes for the week are, got some good ones for you. I mean, I always got good ones, but today's I like. Does anyone want a pack of dead batteries? They are free of charge. Oh, get it. They keep getting worse from here. I just got a job in a factory making plastic Draculas. There are only 2 of us on the production line, so I have to make every second count. 2 counts. And finally, just had an officer at the door saying he was looking for a man with one eye. Told him to use both and he'd probably find him a lot quicker. That kid loves my jokes. Finally, someone's laughing at my jokes. Thank you. Thank you, kid with the weird hat. Let's hear that again. Yeah, I mean, this show's going downhill fast. All right. Disclaimer. This video is only general explanations and education. It is not specific tax, legal, investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which I am not. I'm just some guy on Facebook tonight showing you a sample financial planning process. Okay, just looking at comments quickly. Mariel Sitman, where's the listing of upcoming weekly topics? So Mariel, if you go in the group, at the very top, there's a post. It's called an announcement. It's a post I made previously, but by making an announcement, it stays at the top of the group. So when you scroll through the posts within the group, it should be the first one up there. There's a little table-looking thing that has them all detailed out up through the end of July, perhaps. I'm about to update to add some more months to it. Great question. And I see some other people just post the replies. All right. So financial plan. What is it? Now, everyone knows or knows loosely what an advisor is. Typically, you equate the person or the function with just an investments person. Typically they charge as a percent of assets, and more times than not, they're really just looking to gather your assets and manage them. And the feedback and the comments I usually see across Facebook and other places is simply, well, let me see if you can return more than I returned on my own portfolio management over the last few years, or why should I pay you 1% or whatever for my portfolio when I can just park it in index funds or something like that. And to a lot of extent, that's true. But the actual management of investments, the picking of the stocks, the bonds, the mutual funds, whatever, is really just one small part in the overall financial planning process. It's one of the most well-known parts. For right or for wrong, it's typically viewed as like one of the more glamorous parts and one of the more difficult parts, and it doesn't need to be. There's a lot of people who overcomplicate that process, but it is an important part, but it's just one part. Financial planning isn't just manage investments. That's one piece of it. Financial planning is tying your whole financial life together. Yes, investments are part of it. Retirement planning, college planning, what to do with your house, pay off a mortgage or not. For in or near retirement, things like pensions, social securities. If you have insurance, you could or should tap to use as a source of cash flow. Wealth transfer, gifting, inheritance. Again, home equity, what to do with your house. Do you live in it? Do you sell it to move into a continuing care retirement community? All these sorts of things, and taxes overarching all of that, because almost every single financial aspect of your life has a tax implication to it. Financial planning is the bringing together all of that stuff. It starts with figuring out what's your goals, what do you want to do, what do you want to achieve, whether it's now or in the future, or et cetera. And then basically taking stock of your resources and assets and liabilities, for that matter, to piece together how best to use what you have to most effectively accomplish what you want to accomplish, whether it's saving for college or retirement or whatever it may be. Financial planning is that process of pulling all that stuff together. And yes, getting the investments right is part of it, but again, it's just one part out of many. So a quote unquote financial plan is kind of just the deliverable of going through the planning process and having an advisor / planner / whoever present to you a summary of all the stuff that was discussed in that process, almost always with some sort of takeaway of recommendations. Now, just to kind of cut right to the chase and show you what the end deliverable is, after the result of the process, and then I'll sort of discuss more about the process. I have a couple samples. One is super short. One's on the longer side. Let me pull up a screen share here. All right, here we go. So this is a one-page financial plan, and this is the actual deliverable. Now, I did kind of steal this off the internet. This was a sample given by another advisor. I took off the advisor's firm name just to protect, to give some anonymity to it, and put my own Slick Financial logo. But in its simplest sense, this is a financial plan. This is what you get the takeaway from after having met with a planner. Quick summarization of your goals. This was, in this case, it was John and Jane Smith were the sample client names. Client's goals were Jane would like to retire as soon as reasonable, minimize tax liability throughout life, and maintain dignity and independence in retirement. And then these are the sort of the recommendations as summarized through the planning process, summarized by the advisor and given to the client in this one-page plan. I won't belabor you with reading all of it, but basically here's a quick high-level takeaway about retirement income. Risk management is just financial industry speak for insurance. So here's different insurance things, property and casualty, like confirming your homeowners, your auto insurance, and then what to do about long-term care. In this case, this sample, the takeaway was you can consider the equity in your house as a means to pay for long-term care. Some stuff about taxes, funding Roth accounts, evaluate conversions, what to do about charitable contributions, and then a little bit about investments. Anyway, so as you can see, this is super, super general. Now, granted, this will be customized. These results will be tailored to this particular client's needs and goals. But I don't know that one page is enough. Now, this is hotly debated within the financial planning industry. What is a plan? How big should it be? There's some in the camp of one page is all you need, and it should be something like this: summarize goals and have a few bullets of action items. Now, these are super general action items, but you can refine these in practice depending on the actual scenario. But some clients, some planners feel one page is all you need. Some clients agree with that and are happy with that. They're just like, tell me the top 3 things I got to do. That's it. I don't want or need more detail than that. I trust you. Just tell me what to do. In that case, this one pager could be sufficient. And if you work with someone on a one-time basis, you get this one pager, you read it, you go over it with the advisor, and you walk away, and you two part ways, and it's on you to then implement this stuff. If you work with someone on an ongoing basis, the relationship should still start with a plan of some sort. And then something like this one-page plan would be revised, tweaked, updated, along the way throughout life. Because even the best plan will be stale, will get outdated. It's just a matter of when, not if. Maybe it's a few months, maybe it's a couple years, but life changes, financial markets change, tax legislation changes, your own goals change, things happen. So plans do get outdated, but nonetheless, if you want a one-time kind of direction, what should I do? You can have a one-page plan created from an advisor, and then you're not obligated to work with that person going forward if you don't want to. So this is sort of the shortest and sweetest of deliverable plan should be. And then at the other end of the spectrum, here's a larger one. This is a sample that I actually put out last year. This is 20 pages. Now, I have seen some that other clients have come to me that have 80+ page plans. Now, 60 or 70 of those pages is just a bunch of reports spit out from software, and then the rest of it's kind of some layered in commentary. So this one's 20 pages. This is predominantly output from financial planning software with laced in commentary. So let me just walk through what this is. Table of contents, client summary, some basic info, and then summary of goals, just like you saw in the other one. But this one, again, this is just sample info I made up. But John and Jane also were the clients here, just summarizing their retirement goals. They had charitable giving goals. They wanted to help contribute to grandchildren's college, and they wanted to minimize taxes throughout the lifetime. So goals, pretty straightforward. You know, it all starts with goals, as it always should. And then in the plans I do, I detail out the assumptions used throughout the plan about life expectancy, about the various forms of income, wages, Social Security, pensions, annuities to the extent there are any, expenses, just summarizing. And all this stuff is in more detail in the tables with the report. This is just a summary, you know, summarizing expenses and inflation assumptions, summarizing housing, what they're going to do, life insurance, and then investment returns summarized throughout the plan. And now this is some output from the report, from the financial planning software. There's a net worth statement. This is simply a summary of everything you own minus everything you owe. So investment accounts, houses, those are all on the left side. Those are things you own. Debts, mortgage, credit cards, you know, those are on the right side. That's what you owe. Net those two together. The difference is your net worth. So this particular client owns $1.9 million of stuff, but they have, you know, I'll round up 200 grand of liabilities, of debts. So their net worth is actually 1.7-ish. And then this just details more about the individual financial asset accounts. They have some checking, savings, 401ks, IRAs, whatever. And then there's usually pretty reports thrown in here. This breaks down of all their assets that they own, how much is retirement accounts versus insurance versus real estate versus cash. This gets a little more granular about the investments themselves. This is the big picture one. So equities are 53%, bonds are 37, 38%, a little bit of cash, and then a sprinkling of other. And this just drills down further into the particular types of equities and bonds. And this just shows in tabular format what we just looked at. And now here's a real sort of planning output. And I'll show the system used behind this. I just want to kind of cut to the end and show you like the takeaway of the financial planning process. This is a cash flow report. Now, different softwares approach this differently. The one I use, and there's other softwares out there, they're cash flow based. They do as detailed as possible projections about every year's income and expenses throughout the rest of your assumed life. That's the backbone. You know, that's the meat and potatoes belying all this, all these assumptions, all this analysis. So this just shows every year, you know, calendar year, and I, you know, did this in 2019 or 2020, which is why it looks a little dated, but every year's total inflows and outflows. It's comparing two different scenarios. One was John retiring at 65 versus 62, and just showing you what the difference in cash flows would be. Don't get too hung up on, you know, hung up this yet. I'm just showing it to you. And then another big part of it is what's called Monte Carlo. Now, the difficulty and impossibility of trying to do any sort of financial planning or retirement planning with absolute precision is there's so many unknowns that can and will happen about the future. You know, if you're retiring at 60, there's a good chance you're going to live the better part of 40 years, or not necessarily a good chance, but it's not a remote chance that you'll live into your 90s. Let me rephrase it that way. So the question becomes, like, how do I know with certainty I'm not going to outlive my money? And honestly, it's impossible to say. Because we don't know what your expenses may be. We don't know how investment returns are going to be. We don't know what taxes are going to do. We don't know when you're going to die. If you knew with certainty all those things, this process would be super easy and super, you know, finite and quantifiable. But we don't. So we have to use the best set of assumptions and reasonable projections that we can. But this process will always change. As I mentioned, even the best plan gets outdated at some point. You know, it's not if, but when. So when working together with someone who does planning, you keep revising all these projections along the way, you know, because things, you always want to update them based on most recent and fresh info you have. Anyway, so another big part of financial planning is what's called Monte Carlo. And this helps try to put some reasonable statistical guess around how long may your assets last. In this case, assuming that people live till 95, based on the spending assumptions we have, based on the inflation assumptions we have, and then based on their actual portfolio, and then historical returns and correlations. And correlation just means how one thing moves relative to one another. Monte Carlo takes all this stuff and runs it through 1,000 different statistically possible what ifs over the next 40 years, or whatever the life expectancy is here, and says, out of these 1,000 trials, and how many of them is there some amount of portfolio left over, meaning it hasn't been depleted. In this case, it's 97% of the 1,000 trials, or 970 out of 1,000 trials. The projections show that the portfolio will not deplete. So that's Monte Carlo. And I ran a couple of Monte Carlos, and then finally just wrapping up with recommendations, just like in the one-page plan. Here's recommendations. These are a little more detailed, as opposed to just summed up in 5 or 6 bullets. But each goal and each sort of area of financial planning is addressed with relevant recommendations if there are any. So that's that. So that's the deliverable financial plan. I want to just show you the engine that actually creates it and what the process is. Now, these deliverables, in my opinion, aren't the real value in getting a financial plan. It's the process. It's the kicking ideas around with the advisor or planner. And I'll show you the software, all these different cool things you can do on the fly, these different what ifs and scenarios that bring it all to life. This is just sort of the takeaway you get, the memorialization of the process. Let me just see what kind of questions we got here, if any. All right, Dave Fultz asks, how long does it take to prepare a financial plan? Yeah, great question. It all depends. So let me talk about the process, Dave Fultz. So it starts with, engaging, right? Whether you seek out the advisor, or advisor's at a seminar or whatever, and starts with engaging. You finally agree to work together. Yes, I want to do a plan. You sign up some sort of advisory contract / agreement / planning engagement, whatever it's called, and that will detail. If it's an ongoing relationship, it's going to detail the nature of the ongoing relationship. If it's just a one-time plan, it should detail that. If it's a pure hourly engagement, it should detail that and what the fees are, et cetera. So anyway, once you sign that engagement, then it's a bunch of data gathering. So the planner / advisor should be getting from you all your relevant info. In almost all cases, it's going to be a tax return. So me focused on retirement, these are things I, work with: Social Security statements, pension statements if you have a pension, if you have any annuities or insurance products, I want to see the contracts for those, detailed list of expenses, summary of your real estate, all your investment accounts, mortgages, outstanding debts, things like that. If you have any trusts, your state documents, want to see those. Those are the big ones. If you own any businesses or business interests, whatever relevant documents along with that. So there's a data gathering, and a lot of this is just in document form, which you can often do through some sort of secure file sharing portal. Could be by physical paper if you want. And a lot of it's also going to be verbal, or Zooms to meet with people and discuss things like that. There's also a risk tolerance questionnaire where you try to sort of quantify your emotional views about taking financial risk. Some advisors try to have the client do as much as this as possible. They'll have these massive sort of intake data gathering forms where you fill out all this info and give it back to the advisor. Some advisors have this all streamlined, so they get that form back and it automatically populates their financial planning software. Other people are a little more manual. Some people are they don't have that form, and kind of the advisor will work with the client to get all the info through phone, through Zoom, through email, through whatever. So once you have all the info, it's discussion of the goals as well are part of that process. Then it's a matter of the advisor getting into the system, making sure all data is clean and good, running projections, analysis, summaries, formulating some ideas and opinions based on that. Then whether the advisor has another meeting with the client to walk through it, which is what I do, or if they instead just deliver it all in one big fat stack of paper. That's what some people do. It all depends. But all said and done, David Fultz, time-wise, 10 to 40 hours. It depends how complex you are, how much info there is, how efficient the advisor is in getting data and synthesizing it and running it through the system and coming up with projections, how many meetings they want or need to have with you. And it also depends on the quality of the plan. I know of a guy here in New Jersey. He boasts that he rips through plans in like 2 hours. He charges $500, but these plans got to be real, not very high quality. He sits down with them with his laptop, asks a few questions, and within the course of an hour or two, he's proud that he has a plan spit out for them. Now, I know what goes into planning, and I know you're not getting much very good, at least nothing above and beyond what you can get for free through some sort of online software. And I've seen uber elaborate plans that I know take dozens and dozens of hours, and I've seen stuff in between. So when I do them, 10 to 40 hours. I don't know. Let's call it 20-ish, maybe 30. About average for all this stuff. 20-ish. I don't know. I haven't really charted out the time myself, but 10 to 40-ish feels about right, and it is what to expect. Again, plus the presentation to the client, add another hour or two there. So, you string it all together and it's easily 10 hours. Wouldn't be surprised if it's pushing 40 for a lot of people. Great question. And then I guess this is from Cody. Yeah, data gathering checklist. Thank you for that. Assume this is Cody. All right, so let's now actually look again. This is what I showed so far. This is just the takeaway. Not to say it's not valuable, but I think that the process leading up to that is really what's valuable. So let me now pull up, give me a second here. Okay. Let me share this. All right. So I have financial planning software called eMoney, which is one of the larger, more widely adopted independent financial planning softwares used throughout the industry. Let me just see. There's a question here. So June asks, is it a good idea to provide all of your financial information to potential financial advisors and select a financial advisor who prepares the best financial plan? It depends what you mean by advisor and what you want from that advisor relationship, June. So advisor as a word, financial advisor, honestly means nothing because there's so many different shapes and flavors of advisors and services offered. There's no regulation around the term financial advisor, and any joker can call himself or herself that. So think about what you want. If your goal is, I just want to start with a one-time plan to know where I'm at and get some recommendations, then based on that plan, maybe I'll decide I want or need to hire someone to help implement it and provide some sort of ongoing service and asset management or whatever. Or maybe you don't. Maybe you're fine just taking the plan, implementing it yourself, and then check back in a handful of years with that person or someone else to kind of re-up your plan. In that case, the person doing the plan, you can call him or her an advisor. Again, advisor doesn't really mean much by itself. It all depends kind of what the service you're getting from the person is what matters. So if you're consciously looking for just a one-time plan, then yes, you should be giving all of your information to this person because he or she is going to need it to make a plan that's as comprehensive as possible for you. Then if it's a one-time engagement, you go your separate ways, then you don't need to share your info with anyone else until down the road, if and when you re-engage that person or someone else for something, then you need to share your info with that person. And if you do end up going to someone else, it would be helpful to share the plan you had made from the first person with your new planner / advisor, if that makes sense, June. Okay, so getting back to the software, this is software called eMoney. I won't bore you too much with the details. It's incredibly robust, but I just want to show, the high level, the Fred and Wilma Flintstone are the planning clients here. They have $1.5 million of investments. Here you can see a summary of their investments, including a checking account, savings account. You can see the figures here. And then this difference, the net worth, the other 450 grand is their house. I assume they own a house and it's fully paid for. They are, I think 60 and 61 were the assumptions I put in. They are shooting to retire at 65. They both work. They want to retire at 65, but they also want to know, can we retire sooner? Or do we have to or need to retire later than that? They'd also like to buy a second home at some point in 5 years. They're also considering possibly doing Roth conversions. I figure I have to throw that in there because we're taxes and retirement. They also want to know what happens. The assumption is they're both live till 95, but what if one of them dies prematurely, 75, let's say? Or the other big sort of plan buster is commonly what happens if one has a massive long-term care event, multi-year, really expensive long-term care event, assuming in their mid-80s, and then they die, a few years after having that, that long-term care event. They want to know, can I do it? Can I retire? And that's typically people's, at least in my world, working with people near in retirement, they want to know, can I retire? If not, when? Right? That's the ultimate goal. That's the ultimate question. Now, deceptively simple question on the surface, but there's so much more that goes into it, and it's a mix of things like this, planning software that helps do the finances of it at least. Now, another thing to consider, not to get too off track, but this is just the financial aspects of can and should or when can I retire. As important, if not more important, as the financial aspects or the softer side, the qualitative. sense of meaning, sense of purpose. What are you going to do in retirement? It's unfortunately not uncommon. People run full steam their whole careers, 40 years, whatever, working in a high pressure job, and then just stop. And then it's like, oh man, I'm kind of lost. Now what do? I haven't been home this much with my spouse all day, and we're butting heads, not in a good way. I'm bored, right? I don't feel like getting up because I got no reason to put pants on and go do something. These struggles are real. I've seen it. I've read about it. I've heard it. Anecdotally, lots of stories of people who wish they were better mentally prepared, that they had a smoother transition into retirement instead of running full steam, stopping work cold turkey, and then just hanging out at home. The first few weeks, first few months, maybe first few years are cool because it's like a vacation. But at some point, a lot of people are like, I need to do something with myself now. Not everybody. Some people volunteer. Some people get part-time work for the fun of it. Some people are fine just sitting home and doing crosswords, and that's completely cool. But think about the softer side. What am I going to do in retirement? It's important you retire to something, not away from something. All right. That's my bit about the non-financial stuff. For now, let me just stick to the financial stuff. All right. I see some good questions here about pensions and life insurance. I will get back to that. That's a great one. So one second. So it starts with cash flow. At least this e-money system does, and a few other ones do. And this is the system that generates that report you just looked at. So we're actually in the back end now. I'm assuming Fred and Wilma told me they spend about $120,000 a year. Is this right? Yeah. $120,000 a year of normal living expenses. And they anticipate that's going to last forever. And there's inflation assumptions built in, so you can see these expenses tick up every year. Now, there's some higher stuff going on here because this is inclusive of taxes. But anyway, normal living expenses, 120 grand a year. Systems like eMoney are smart enough to calculate what taxes are or should be each year, and they throw taxes in on top of normal living expenses. So long story short, this cash flow report is just a glorified spreadsheet. It shows all the income coming in. The base assumptions are going to work until 65. So you have a handful of years of income still. Then after that, the wages stop. So this income tails off, but then Social Security starts. Wilma is the higher earner. The assumption is she delays Social Security until she's 70. Fred's the lower earner. He's starting his at his full retirement age of 67. So anyway, so wages stop, picks up with Social Security, and then Social Security is your only income source from there on out. It'll do RMDs, this planned distribution column. This is assumed RMDs that the system is calculating based on what its tax deferred balances are and what it assumes they may be in the future. And so these are your total inflows. Then again, expenses or living expenses plus taxes. Add it all up. Your net cash flows are the difference of your total cash coming in minus your cash going out. If it's an excess, that implies you're saving. Like all these years they're still working, they have excess cash, so that just gets dumped back into savings or investments. Once they retire and wages go away, they're spending a lot more than they're taking in, so you have these cash deficits. That is funded by pulling money out of their portfolios. And then different planning softwares have different assumptions of the order of how money is withdrawn. Typically, it's first from cash, then taxable brokerages, then tax-deferred accounts, then Roth accounts, but that's customizable and tweakable in a lot of softwares. So this cash flow just spells out every year for the rest of their assumed lives how much money is coming and going, and kind of what that does to the anticipated portfolio. Now, cash flow is good again just for seeing trends in income and outflows. It's not good for figuring out how much money may I have, if any, when I die, because this is a linear projection. If you look at this final column on the right, this total portfolio assets, this is just taking the average historical return of their portfolio and assuming that average return happens every year going forward. In reality, financial markets don't do that, right? You're not going to get a neat and pretty 7%, 7%, 7%, 7%, 7%. There's going to be years you get 10 or 20. There'll be years you get something negative, and then all kinds of stuff in between. So cash flow report isn't great at predicting assets. It's good at guesstimating what your cash comings and goings may be. So that then begs the question, okay, well, fine. If this doesn't answer, do I have enough money to retire? What does? That's the Monte Carlo report. And let me show you a different view of this. And this is where the planning process really gets cool. So software like eMoney allows you to do these shift on the fly what ifs All right. So based on the assumed expenses, they're assumed living till 95, their assumed base case retirement age is 65, and their portfolio as currently invested, running 1,000 different trials of what may potentially happen to financial markets over the next 30 something years until they're assumed to die at 95, what's the chance of their portfolios not depleting? Statistically, there's a 95% chance, according to the fake data I put in here. Now, how should this be interpreted? Some people will say anything less than 100% means that's not acceptable. It's not. That's not true. While it's nice to see 100, Monte Carlos typically just look at the investable assets. It doesn't look at home equity. So even if and when Fred and Wilma's portfolios depleted in their later years, they'd still have home equity. They'd still have Social Security coming in every month. They'd still have whatever pensions they had if they were to have some. Plus, like I said, we're projecting out 30 to 40 years with this stuff. This will be wrong. Life will not play out like this, right? Maybe it'll be better, maybe it'll be worse, but we will tweak this along the way. You're looking for trends. Anything over 80% Monte Carlo is good, over 90% is really good. That just means, yes, based on what we're assuming, there's really good chance things are going to work. Knowing that, you will need to be agile and tweak and adjust along the way. But the point is, if this showed 60%, we'd be like, oh, yeah, nope, this plan doesn't work. You got to work longer. You got to spend less, some combination of the two. Anyway, so Monte Carlo isn't like the end all be all. It's just another tool to help figure out, can I retire? Can I meet my goals? Again, we can't say this stuff with certainty because who knows what the future is going to hold. The best we can do is make reasonable assumptions and projections and educated guesses. And Monte Carlo is one such tool. So anyway, getting back to this is the planning process. So this is what someone should run through with you when discussing with you a plan. But this is all the base case. Again, this is both living till 95. This is retiring at 65. This is spending the 120 grand a year plus inflation every year, starting Social Security at 70. What happens? And these are pretty good results. You're like, okay, cool. So we can stop working at 65. What happens if we buy our second home for 300 grand in 5 years? Can we afford it? Well, let's see what that does to the Monte Carlo. Obviously, spending 300 grand, is going to make the results not as strong, but this is still far from terrible. Again, anything over 80-ish is good. 90 plus is really good. This is still within the realm of reasonable, but again, keep in mind, you need to commit to have some level of agility and flexibility and roll with the punches as they happen, whether it's your life, tax legislation, financial markets, whatever. You may say, okay, cool. Now let's keep pushing this. What if instead of 65, what if Wilma retired at 62? And Wilma's a higher earner, mind you. I have her making 200 grand a year until she retired. Ooh, this isn't good. So if Wilma were to stop at 62 instead of 65, this plan probably isn't going to work. If they were to buy the house in 5 years and live till 95, now the chances of them depleting their portfolio is relatively high. Let's back this out. Well, maybe we don't buy the house, but Wilma still retires at 62. What does this look like? Okay, much better. Not perfect, but still we're in the green zone, if you will. What if instead we got a cheaper house, only $200,000 instead of $300,000? Okay, not great, but we're getting a little better. Okay, maybe Wilma decides, you know what? I'll work till 68 because I really want this house. Let's see what this does. Much better. So you see where I'm going with this. It's a give and take. You can have the infinite combinations of what if I do this, what if I do that, and it's all a function of helping you, the client, figure out, what goals are your priorities? What's most important to you? Is it stopping work at 65? Is it having the second house? Is it, whatever other combination of things you want to put in here, whatever other goals or purchases or whatever. This is the planning process. Now let's just go back. Okay, so we both stop work at 65. We still buy the second house in 2026. Okay, not bad. 91% Monte Carlo. Let's go back. Let's re-up it. What if we instead buy the $300,000 house now? Okay, not horrible. Still pretty good. What if we trim our expenses by 10 grand from 120 to 110K a year for the rest of our lives? What does that do? Oh, big difference. Look at that. $10,000 a year in this case, in these scenarios, makes a big difference. Now let's start shocking this plan. What if Fred died at 75? So Fred lives on, Wilma lives on until 95. Fred's Social Security goes away. Wilma keeps just a survivor benefit. Wilma's taxes go up some because of the widow/widower kind of tax penalty. Plan still works. Now, also keep in mind, if Fred were to die, chances are expenses would decrease some. Maybe Wilma would sell the second house or one of the two properties. So lots of things could move. So don't get too hung up on these results, but nonetheless, planning process is trying to show orders of magnitude and kind of sanity check and reasonability checks for things you want to do. The plan buster is often, what if there's long-term care? So Fred at 85 has really expensive long-term care for 3 years and dies. Dings the plan somewhat, but doesn't completely crush it. What if they kept their expenses up until then? We're going back to 120 grand a year of expenses. Ooh, yeah, that kind of hurt it. What if Wilma had retired at 62 and all this stuff happens, including Fred having long-term care? That's not good. You don't want to see 50%. So, this combination of things isn't good. Maybe Fred works later till 68, whatever, and that'll improve the results. So that's Monte Carlo. Let me stop. I mean, I can come up with infinite combinations of random stuff to look at here, but this is a big part of the printing process. For those that get into taxes, another thing is tax projections. And software usually has cool reports like this, and this can be included in the output for the financial plan deliverable. This is just a graph showing anticipated total taxes to be paid over Fred and Wilma's remaining life. You can see taxes are relatively high while they're both still working, and then they retire and taxes are zero or close to it. And then they start ramping up when Social Security starts and RMDs kick in. And then you can see as based on these projections, their tax deferred balances will likely grow over time. So RMDs keep growing and taxes keep going up. And then here's just in tabular format showing the total tax calculation each year. So what do you do with this? This is a graphical depiction of where the tax planning opportunities are. So look, while they're working, taxes are high. These probably aren't the years you want to do conversions and stack more tax on top of it. But then you got this trough. You got a handful of years where taxes are really low before Social Security kicks in and RMDs kick in. These are the years you would plan to do some good tactical tax planning, pulling forward some of this tax deferred money, realizing it in these years while you otherwise have no or minimal taxes, maybe doing conversions, whatever. And I actually did a scenario with conversions just to show they're going to convert 70,000 a year between now and 2025. I think I did. And don't get too hung up on this. Again, these are just random info I made up. Don't think like, wow, this is going to have the same result for you if you were to do these same conversions. Let me just look at Monte Carlo. So you can see kind of the impact of conversions. If you didn't do conversions, for example, in this case, there's an 87% chance their portfolios will last till they die at 95. If they were to do $70,000 annual conversions for the next handful of years, chances are better. Why is that? Well, because they're getting taxes out of the way now, letting the money grow later. Specifically, they're taking it out of tax deferred, putting it in Roth. And Roth, if you invested aggressively to be saved for the long term, that growth is all going to be tax free when they eventually tap it. So it helps the likelihood of them not depleting their portfolios because there's less of a tax bite in the future. And then other things you can do with financial planning software or include in the financial plan. I mean, there's infinite number of reports you can do around investments. Like I showed you one before, you can look at investment allocations. There's 60% equities, Fred and Wilma, and then 40% cash and bonds and whatever. You can look at holding details if you want to summarize for the client their individual positions in every account. And this is just stuff I made up. So they have a brokerage account with a bunch of individual stocks. They have IRAs and Roth IRAs with Vanguard funds. Let me leave it there, I guess. So and there's lots of different ways to do this. There's no single standardized way to do financial planning. As I mentioned, some people bust through in an hour or two and they're proud about that. And they'll give you a one-page couple graphs and say, yes, you're good. You're on track. Other people do super, super granular and almost overly detailed projections and predictions and things. Because again, you're predicting 40 years out. It's impossible to say with certainty what's going to happen. So there comes a point where there's diminishing returns and trying to get too particular and too precise about trying to figure this stuff out because there are so many educated guesses and assumptions. So anyway, the process could be slightly different. The deliverables can be different, as you saw. But this is a financial plan and the financial planning process. I'll leave it there. Let me run through some questions. Feel free to ask whatever else you want to ask. Where was that one I saw before? Okay. So this person asked, do you consider the following a net worth? Pensions, life insurance, and long-term care? Great question. There's different schools of thoughts. Another one is, do you include Social Security in it? So generally, no. On a net worth statement or balance sheet, some people may say it's just actual accounts that have assets, like things you can liquidate today if you had to. Maybe today, maybe in a few months, like your house, for example. You can't liquidate a house in a few months, but you can sell a house, albeit it may take 1, 2, 3 months to do. And then investment accounts, cash accounts, yes, you can get out of them. You can liquidate them. You can take the cash and do other stuff with. Those are assets that you definitely include on a balance sheet, on a net worth statement. Also, cars, if you want, you can sell a car. Jewelry you can include. You typically don't include things like pensions, assuming that pension, it's not an asset. Unless you take the lump sum, then yes, you can invest your lump sum. You consider it a regular financial asset, just like an IRA or brokerage account or whatever. But if it's a lifetime stream of income, whether it's a pension or Social Security, no, you don't include them. How do you account for it? You kind of don't. You account for it in the cash flow statement that I showed, in the cash flow projections. But like Social Security, for example, if you die tomorrow, there's not a lump sum of money, or even today, you can't opt to take a lump sum equivalent of your Social Security and go use it for something else. In that sense, it's not a readily available resource like your house is, like your cash accounts are, like your brokerage accounts are. So for that reason, Social Security is not included. Along those same lines, you wouldn't include a pension. If you have an annuity that's annuitized and it's already, pumping out this stream of lifetime income, same thing. You typically wouldn't include that. Now, some academics, some planners are of the thought that, well, no, you should include those because you're getting something. So let's back into like a present value lump sum equivalent of your Social Security, of your pension, of your annuity, and consider them a bond or bond-like investment because they're safe and stable. I don't believe in that view. Most people don't, but there is an academic argument to be made. So that's pensions. Life insurance, if you have cash value, definitely. The cash value, again, going back to like, I can take this and use it for something now, that should be on your net worth statement on your balance sheet. So if you have cash value, yes. If you have term insurance, no. Like me, I have term insurance. If I die, my family gets paid out the proceeds. That is in no way captured on my balance sheet now. If and when I die, and the death benefits paid out to my spouse, then yes, then she can include that lump of money on her balance sheet because it will be actual physical money she can then take and use. But while I'm alive, no, term balance is not included. Long-term care, same thing, no. If you were to try to put it on a balance sheet, you have a account receivable, if you will, but that receivable is conditioned on you having a long-term care event. Only then will it pay. And even then, you're getting a cash flow, right? Those benefits are like a daily payment you're going to get from the long-term care policy. It's not something you can take a lump sum instead and be like, forget you. Give me 300 grand now. Let me walk. It doesn't work like that. So no, long-winded answer to say the things you mentioned typically aren't included. Unless the life insurance is cash value life insurance, then definitely yes, the cash value should be included in your net worth. Great question. Okay, what else do we have here? Brad Brookner, since I'm sure e-money is not financially reasonable for the average person who does not have a financial advisor, do you have any other favorite free or paid financial planning tools? Yeah, it looks like someone may have replied. So I'm not promoting anything in particular. I know Personal Capital has some sort of free tool with paid upgrades to unlock other features. There's something called New Retirement, same thing. They have a free kind of e-money light financial planning software. And then for subscription, for pay, you can unlock additional features. I don't know. I'm assuming there's other ones out there. I frankly never looked into it, but Personal Capital and New Retirement are the two that I'm aware of that do have free versions, albeit I think the free versions are relatively stripped down. But I don't know for certain. Great question. So this looks like this was in response to you. Yeah, flexible retirement planner. Do I have any tax planning software as a supplement or only e-money? So no, I don't, and I considered it. There is software out there. There's something called BNA, as in Boy Nancy Apple from Bloomberg. There's something called Income Solver. But projecting out taxes over multiple years or decades is futile. Because there's so much unknown. This is one of the things where I think there's diminishing returns with trying to get too precise with these projections. Like now, for example, there's so many things up in the air and proposed with pending tax legislation. Who knows what's going to manifest, how it's going to play out. Not a political statement, but Biden has 8 to 10 things on his wish list that he's proposed to the world that he wants to do. There's no way all 8 or 10 make it into legislation. In reality, 1 to 3 or 4 of his big ticket items may. In what form they'll actually take and how severe, nobody knows. So trying to predict this stuff is pointless. We know taxes are going up. So what I do in eMoney is it allows me to say whatever the client's effective tax rate will be based on what we know current legislation is, I can ratchet it up by 2 percentage points, 5 percentage points, 10 percentage points. That's kind of the best I think one should do in trying to account for future tax increases, because there's way too many things to try to guess to do with precision. So no, to answer your question, I don't supplement eMoney with additional tax planning software because I think it's kind of pointless, because we're trying to solve for the unsolvable. The best we can do is look for trends, like I showed in that graph. We know Fred and Wilma have a lot of tax now while they're working. Then their wages go away. There's a big lull in their taxable income. Those are the years to get ahead of the potential tax bomb in their tax deferred accounts, and do some conversions, do some distributions. So, but the actual amounts to convert, to distribute, that needs to be a year by year thing. It'd be silly to try to predict today what Fred and Wilma should do in 5 years in terms of conversions or IRA distributions, because too much stuff's going to change. I can say that with certainty. So that's where the benefit of an ongoing relationship comes in. As tax legislation changes, as financial markets whip around, as Fred and Wilma's life plans change. Maybe Fred gets kicked out the door tomorrow, and guess what? He can't work till 65 because the quarry, working for, what's the guy's name? I forget his name. Whatever. Fred's saying working that crane, he gets pushed out of work and he can't get work again. That's going to drastically change his plan, and that's going to change the tax planning around it. So for that reason, I don't think it's worth trying to get that granular about future tax projections. You have to kind of roll with the punches year by year when you do your tax planning and figure out the actual amounts to convert, to distribute, to sell, to whatever. Great question. Okay, so Brad, from David Fultz, how frequently does the financial plan need to be updated or revised? It depends. I mean, anytime there's a major life change, obviously. So like people I work with, my process is every 6 months we do a formal revisit and update of the plan. But it's not like people can only talk to me every 6 months. As life happens, let me know. Like that Fred and Wilma example. You think you're going to work till 65, but guess what? You get tapped on the shoulder at 63, they boot you out. That's a big life event. That definitely warrants a change in plans. Death of a spouse, obviously. Serious illness, obviously a change of plans. To the extent there is some massive change in the financial markets, like if we have another 08, 09 and things sell off, that shouldn't derail the plan, because a good plan should already account for there will inevitably be a nasty turnaround in the stock market. I don't know when, I don't know how severe it will be, but assume it will happen. So the investment allocation should account for that. But what may change is that year's tax plan. So if there is a huge dip in stocks, that's a great time to do some conversions if you're planning on doing conversions. So don't wait, the 6 months to talk with me again. When the markets tank, we're going to get in some conversions. So that'll update the plan, in that sense, David Fultz. If you're not working with someone on an ongoing basis and you just get a one-time plan, kind of depends. It depends how many life change events you're close to or have. Like if you're 1 year out from retirement, it'd be, you get a plan done then. Maybe you want another one when you're actually entering into retirement, just to refresh and set you on your way. But if you're 10 years out from retirement, you get a plan done now and not much changes in your life, you can probably wait a handful of years, if not longer. It really all depends. So not a great answer, but it depends on the circumstances and how much changes with you and your scenarios and your assumptions, Dave Fultz. My last financial plan with Monte Carlo scenarios was done in 2019. My circumstances have changed since then. Should I have a new plan done now or wait until next year when I'm closer to retirement? Yeah, I can't say without knowing your plans, your goals, and how off or how different or how outdated your plan is. I really don't know. If there's no other major changes, maybe you can wait until you're actually closer to the cusp of retirement. But I really, don't know, user. Now, for what it's worth, the fact that you even have a plan is great. A lot of people don't. A lot of people wait until the life event happens, which is, okay, I just retired. Now what do I do? It would have been better to get ahead of that by a few years and do the planning then. But nonetheless, the fact that you have a plan is already a great start. I don't necessarily know you need to worry about keeping it super live, super refreshed. But yeah, don't let it get too stale. When it's too stale, I really don't know. It's based on your circumstances. Do you count home equity in the bond portion of your allocation like a long-term bond? No. And that's an interesting question. So home equity is definitely included on your balance sheet, in your net worth statement. If you own a $500,000 house, you own it outright, that $500,000 of stuff you own should be reflected. But it is not, I never, and I don't think anyone really does. Again, I guess there's an academic argument to be made, but it's super, super rare, if at all, for people to include home equity as a bond or bond-like safe asset in your asset allocation. The academic reason why you may is because home equity could be used. Josh Blum was on a few weeks ago talking about reverse mortgages, which can be a very valuable tool in the right set of circumstances. Not right for everybody or every circumstance, but in the right set of circumstances, reverse mortgage can be tremendously valuable. You can tap that as a source of cash flow, borrowing against your home. So in that sense, that's the reason why there's an argument to be made for treating your home equity like a bond-like asset, because you can tap it for some cash, but it's very uncommon to actually treat it that way. It's just kind of something hanging out there. You have your investments, your stock, your bonds, your mutual funds, whatever. Then you have your home equity. It's a separate thing that's part of your balance sheet. Okay. I'm participating in the 2021 Financial Planning Association externship, and eMoney is part of that. Is it difficult software to learn? Nah, there is a learning curve, but no, once you get a hang of it, it's not that bad. It is more robust than like Money Guide Pro is the other big one used throughout the industry. eMoney is hands down better and more granular and detailed. So there is more learning to come along with it. But once you get the basics, you're pretty well on your way. Where it gets more complicated is modeling things like annuity and use of home equity. That's the next level stuff. But eMoney's got great training and support for what it's worth. Alrighty, it looks like that's about it for the questions, actually. Oh, yeah, David Fultz. Mr. Slate, that's right, from the Slate Rock and Gravel Quarry or something. Yeah. Brad Brookner as well, Mr. Slate. Okay, any other questions? Hope you all found this somewhat interesting. I know this is really off the topic of what we normally discuss, but I thought maybe some people would get a kick out of it and find it interesting, seeing what actually goes into a plan. Give it another couple seconds. Okay, so here's a question. Does financial planning software typically include detail that can incorporate IRMA penalties? eMoney does not. The other more detailed ones may, like BNA and Income Solver might. But no, eMoney does not. eMoney also does not account for like ACA tax credits. It's not quite that slick. Tax projections are hard, and almost all software, unless it's something super high powered built specifically for tax projections, eMoney, Money Guy Pro, they're going to fall short in really robust tax planning. But I'm okay with that, like I said, with eMoney at least, because again, my view is there's way too many things to possibly try to model that will change over time, that it's kind of futile to try to model it all. So things like IRMA, not to say they're not important, but what I do, and this is where my tax knowledge comes into play, I know what the IRMA thresholds are. At least I know what they are now, right? For a single person and a married couple and et cetera. So when I do tax planning, when I do income distribution projection planning with people, I just know those levels are burnt into my head. Things like Income Solver and BNA, they may have that modeled in. whereas eMoney does not. But again, I think as long as you know what to look out for, that's kind of good enough. Plus, even if Income Solver and BNA do account for IRMA, what's to say IRMA won't change in 2 years and 5 years and 10 years and change dramatically, perhaps, right? So there's still so many unknowns about this that I think it's kind of getting too far ahead of ourselves to try to detail and model this with granularity with that level of specificity. Good question, though, whoever this was. And great knowing what I should get done. Thank you. You're welcome. Brad Brookner, very interesting. Makes me realize I'm thinking about the correct stuff. Yes. If all the stuff we went through tonight, Brad, looks familiar or things that you thought about, then great. You're well on your way to appreciating and understanding what a financial plan does. Did I enjoy my trip to Texas? Yes, Texas was a nice trip. It rained the entire time from when we got there Saturday morning to when we left Tuesday morning. Or at least it rained rained a lot of the time, was gray all the time, but otherwise it was a great trip. Saw some good people, saw Cody, had some barbecue, had a fantastic chopped brisket barbecue sandwich from a gas station. Yes, it was a Buc-ee's for what it's worth. I was not skeeved out by going into a Buc-ee's and seeing their hot sandwiches. If I went to an Exxon and bought a hot sandwich, or like one of those rolling taquitos in 7-Eleven, that'd be asking for trouble. But the Buc-ee's sandwich was nothing short of awesome. All right. Would using a financial planner be helpful to decide if one needs long-term care versus having adequate personal funds to cover a bad outcome? Perhaps. That's definitely one question that a good planner, generally retirement-focused planner, should be able to assist with. And that's a very important question. So anyone you engage with who puts himself or herself out as a retirement-focused financial planner should be able to help you with this question. Now, they won't necessarily be able to sell you a policy like me. I intentionally have no insurance licenses, so I can't consummate a product sale to you, but I can still nonetheless do the analysis and help you determine, like we did with Fred and Wilma. Let me just go back to that quickly if you're interested in seeing. How do I approach, can we self-fund long-term care? Do we need to consider long-term care insurance? Well, that kind of comes down to cash flow, but more so Monte Carlo, for example. And I did run that scenario. So what I ran here, let me just take this question off. What I ran in this assumption is starting at 85, Fred has a significant long-term care event. By significant, I mean it costs in today's dollars $120,000 a year, so $10,000 a month, but inflated 5% per year forever. So by the time Fred's 85, that's like 300 plus grand a year for 3 years. Then he dies. So let's see what happens. So they both retire at 65. At 85, Fred has this 3 years of really expensive long-term care and then dies. Then Wilma lives on until 95 with 83% chance Wilma's portfolio does not deplete before she dies at 95. So now you discuss, are we okay with that? So 83% is still not bad. If this was like 60 or 70, I'd say, yeah. If Fred has this long-term care event, Wilma may be in some trouble down the road. So should probably consider some long-term care insurance because you don't look like you can safely self-fund. In this case, this is pretty high. The assumptions I use for long-term care, I think, are fairly drastic. 120 grand a year in today's dollars, inflated 5% per year indefinitely for 3 straight years. That's a pretty severe long-term care event. And so 83% is a pretty respectable Monte Carlo output for that. So this would answer no. Based on what I see in projections we're doing, I don't feel you need long-term care insurance. Fred and Wilma, could you benefit from it? Sure. If it'll give you some peace of mind, like if one of their goals was to preserve as much of their wealth as possible to transfer to Pebbles, to their kids, then maybe yes. Then you want to consider long-term care so that if and when the long-term event happens, you don't have to dip into so much of your portfolio. You can let the insurance pay for some of it, and you can preserve as much of your portfolio as possible to pass on to Pebbles or whoever you want to leave it to. But if leaving a big legacy is not your goal and you're fine spending down your assets, then no. In this case, I would confidently say it looks like you can self-fund if and when the long-term care event happens. So yes, to answer your question, a good planner / advisor should be able to do this analysis or something like it for you. And yes, Kerry Peabody, he was a long-term care specialist a month or two ago. He sells long-term care. That's all he does. He's in that business. he's another good resource to go to figure out specifically long-term care and related, health needs. He can help figure out what particular policies, what provisions are good. Whereas me, I'm just a generalist saying, I think you can self-fund. If you want to consider a policy, then you work with someone like Carrie to even double check my assumptions and to work through finding the specific policy that makes the most sense for you if you do decide to ultimately to get a policy. All right. Give it another 10 seconds in case there's any questions. Otherwise, we will wrap it there. I will play for you my laugh track one more time after I tell a dad joke because I like it. Oh man, that is gold. That is absolute gold right there. Okay, looks like that is it. So we will wrap it here. Thank you all. I will see you next week. Next week's topic is, I believe, Kevin Lyles will be on again next week. Is it? Yes, Kevin Lyles. We will discuss where you'll live and whether to work in retirement. As you may recall, Kevin was on before. He is his wheelhouse is the softer side, the purpose and the meaning of retirement. Definitely want to check that out next week. Until then, I will see you all and have a good week. Good night.